Good afternoon. Scott Choppin with Urban Pacific Group of Companies joining you here today from Long Beach, California. Today we're going to talk about an article from Alan Matkins and Anderson UCLA, who does the California Economic Survey on an annual basis. They do also a very significant and well-known economic report, predominantly for California, as you'd expect, being based in California. And we're going to talk through some reactions and thinking from Kitty Wallace, who's a well-known investment sales broker in Southern California, and giving some feedback related to questions that the Anderson folks asked of her in an interview-style article. We just find it interesting seeing the opinion of Kitty Wallace in today's marketplace, and particularly want you guys to focus on both her near-term assessment, what's happening right now during the coronavirus pandemic, but also looking specifically out in the next 3 to 5 years and the health of the marketplace, and particularly bringing it to you today as an investor who's potentially looking for investments in California or just solid multifamily investments generally. We think this is a good article to give some of Kitty Wallace's opinion based on a lot of investment sales and make it relevant to today's economic environment, looking at it from the standpoint of a multifamily investor. Thanks so much, and here we go. So this is Alan Matkins' UCLA Anderson forecast. Basically, what they do is they do regular economic updates. UCLA Anderson is a very well-known industry association related to UCLA. USC Lust Center would be the version across town at USC. And basically this article is talking about, housing demand, minimizing multifamily market downturn. And this is a couple of different folks, mostly which will focus on Kitty Wallace, who's a senior VP at Colliers and very well-known industry expert in the brokerage community, specifically focused on investment sales in the multifamily marketplace. And basically taking, their synopsis and some of their opinions and interesting thinking based on the UCLA Anderson forecast that comes out annually, and some of the commercial real estate survey work that they do about that, where they survey commercial developers, owners, investors, folks in the brokerage community, and those that are ancillary to the commercial industry. So the first question is, the latest survey shows a significant drop in sentiment among participants. However, in both the Bay Area and Southern California markets, most participants stated that the pandemic had no impact on their plans for development activity. Why is that, given the current uncertainties? ? And Kitty here talks about, you can see these highlighted areas. Basically, she's talking about, while they've seen a softening in the rental market related to coronavirus, and softening, she doesn't say what it is here, but from our own research, we can see that rents are softening, but they're softening in different, product categories within the real estate development marketplace. So this would be around new construction, multifamily, and then existing multifamily assets. And really where we're seeing it, and just sort of read into her statement here, is that particularly in the high-end luxury A product, we're seeing, and particularly newly leasing assets, we're seeing some decline in rents. The stats differ, but, we're looking at between 1% and 5%. We've heard some markets that are, above 5%, but no more than 10%. Depending on really the competitive landscape around it. So downtown LA is probably going to be seeing more rent declines than we would see in other markets that have less new product delivery. Downtown LA and Southern California is the largest delivery of new units, statistically in all of the Southern California marketplace. But then she goes on to say here, the highlight in yellow, the fact remains that there's a housing shortage, and these submarkets in California remain some of the top job markets in the country. While many economists project little to no rent growth over the short term, most expect the market to fully recover and experience similarly high rates, likely even reaching historic highs over the next 3 to 5 years. And I think of everything that I'm going to show you today, this is probably the most key statements, because I think it shows Kitty's really, clear understanding of the marketplace that she deals in, which is in Southern California, that while we are seeing, short or near-term softening particularly when we looked at the marketplace in like March and April. I mean, people were exceptionally bearish around the multifamily business. Investors, withdrew from the marketplace. Lenders shut down. Not everybody, but many. And but the fact remains that Southern California and California generally is still a deeply undersupplied marketplace. And for those of you folks that are out in the investor community looking at markets that you might entertain, either you're looking at California actively, prior to coronavirus, or as the market's disrupted, California may show up on your radar. While California does have a reputation for having the highest housing costs, both in rents, meaning those that tenants pay, as well as what investors pay, it really is the most deeply undersupplied marketplace in the United States. And you might argue that a place like New York has, equally high demand. But really, if you look at New York in a certain sense, they actually have the capability to deliver a lot more housing than California does. We in California have the just exceptional resistance in the political environment against new housing. We'll get into some stats in another article, but we realistically should be producing 300,000 units a year in California to catch up. Maybe some people might say 200,000 units a year to maintain and catch up, and we're doing 80,000, maybe 100,000 in some good years. So we're at half the rate or less, maybe 40% of actual production needs. And so that feeds into this undersupply story, right? Then as an investor, you may even look at, specialized product types that may be performing exceptionally well in this environment. One of the other articles I read basically said that they thought the B product categories were going to actually be most enhanced in this coronavirus era, because basically you'd have people that were coming out of A product that decided that they wanted to basically maybe a bigger unit for less rent, or at least lower rent, and that they would move out of that A product into a B. On the C category, there's some debate. We're seeing basically opinions and statistics that support C as an okay environment, although again, people are arguing that there may be some logic for C to move up into B as B falls in price, that there may be some opportunity for people to upgrade. But also people are arguing that the C marketplace is actually going to be the hardest hit, related to job declines related to coronavirus, and that those service industry workers, those workers that are in the service economy, predominantly live in C product, and that they would be under pressure to maintain their capability to pay rents. Now, we're also thinking, and this sort of fits in with our business plan, that as people move out of B and C, or even A and B, my argument is, and really internally, this is sort of philosophy that we have at Urban Pacific, that those people are going somewhere, right? Like housing being a fundamental, biological human need, that these people who move out of really any A, B, or C product category that are having difficulties with employment, maybe underemployed or laid off, that these folks are going to move somewhere, right? And we ask the question, where do they move? And in fact, our product, UTH, is really set up and anticipated that people that would combine together in larger family groups or larger roommate groups would have, need for unusually, more or larger bedroom counts that could facilitate their economic sharing lifestyle that's needed more in this recessionary environment. So as we go through the rest of the article, the next question comes up, with the current work from home requirements, do you anticipate people moving away from dense communities where you would typically see multifamily housing? Why or why not? And Kitty gives one of her answers here, which you see highlighted. She says, post-COVID-19, some of these residents are temporarily moving back in with family to manage unemployment or underemployment as job prospects have dwindled, which I mentioned just a minute ago. Further, she says, others will move to different communities for lifestyle or financial reasons, some to less dense locations and others to suburbs or other markets. For each resident moving out of city centers, however, others who are faring better economically or desire to live in these major markets will continue to increase filling in any gaps made by those who left. So she makes several really good points here, but a few I want to highlight. One, she talks about this, people moving temporarily back in with family. Now, we can argue how temporary is this move back home for boomerang kids, say. Our argument is actually there's a longer term trend towards multi-generational living as a permanent lifestyle. Either culturally, families who live multi-generationally continue to do that and maybe do it, more strongly, right? Like boomerang kids come home and maybe live at home permanently. And that, if you look at the statistics from 2007 to 2009, Pew Research basically did a report that indicated that 49 million households basically recombined, some people describe it as decoupling, but it's basically people moving out of their own house to move in with others, right? Be it their parents, their in-laws, whoever it might be. And that's 49 million households, not 49 million people. So arguably, if you said every household was two people, that's easily 100 million people that made the move in that 2007 to 2009 era back to a group, their family, roommates, but that the trend from an economic recession standpoint was to be defensive, right? To economically share, which is the claim that we made before. Others will move to different communities for lifestyle and financial reasons. Now, one of the arguments that's going on right now, debates, people making, giving opinions about how it's going to work, is that the first one is that a lot of people, everybody is going to move out of the urban centers to suburban, right? Like, just a blanket statement about, mass movements as people can work from home and work for remotely, that, particularly say tech workers in the Bay Area can go live anywhere that they want. Now, so that's the anticipation by economists, by people, demographers who anticipate these kind of things. For us folks in the housing industry are particularly interested in that. But the statistics aren't supporting that. So Zillow came out with a study based on their search parameters for people that were in one location searching for housing in another location, that Zillow basically came to the conclusion that while people were looking to move, they weren't looking to move from, say, San Francisco or downtown LA to some rural, far-off location in the Midwest. Really what they were doing is they were looking at the next town over. So if anybody knows the Bay Area, if you're in the city in San Francisco, people were starting to search and look in Marin County, Contra Costa County, Alameda a little bit, some farther off locations like Sonoma and Napa. And, I don't have a map in front of me. If you look at this, basically this is moving to a suburban or bedroom community, but still co-located to the city center. And it makes sense, right? If you're in the tech business, while you can work from anywhere remotely, and some people will, right? This is we're talking in general terms. The idea of moving entirely away from Silicon Valley, where you have the capability to interact on an interpersonal, in-person basis. Yes, use of virtual meetings and Zoom has increased massively in the last, few months since we have had the pandemic, and we're certainly seeing that as much as anybody. There's still a story for people who have roots in communities, who have the need to continue to go into the office on occasion. So I think we're going to see movement to some degree, but not at the mass levels and not at the distances that a lot of people are saying. In fact, the argument I make is you're going to have 20% of the population that sticks. You're going to have basically, say, the vast middle, 60% of the people, and still on a spectrum of people who will move the next town over. If they can work from home, they're going to move from San Francisco to Marin County, or they're going to move from LA to, say, Claremont, or some move like that. And then you're going to have the other end of the spectrum, 20% of the group, people who will totally move to this small rural town. They're just out. They're going to move away. Okay. And then, to finish this is basically, she's making the claim, which we agree with, that although people are going to move out of the city center, there still is the story of California being an immigrant gateway. Now, immigration is down for various reasons. The immigration, patterns aren't as friendly. The capability to get visas is lowered. But at the end of the day, in the long term, right, in the long term, California, in our minds, will still be an immigrant gateway. Now, the question then becomes, how long do those people, when they move to LA, immigrating from another country or from, from wherever they're immigrating from, how long do they stay in California? And I think that's the question is, do they stay long term? Do they put down roots in Los Angeles, or are they here temporarily because then they can move to some other place? Maybe they move to a red state because they can get, good salaries there and have half the housing costs. And in fact, our business plan around the urban townhouse model really is to facilitate the capability to have a large family rental housing product in urban centers, not central business districts like downtown LA high rise, but neighborhoods that are 2 or 3 levels out from these city centers that allows these families to live the lifestyle that they want in a multi-generational, multi-earner household like they're normally used to and is common throughout the world. But that is attainable or naturally occurring, affordable to them so that they could consider staying around. Now, this isn't to get into the debate between the capability to afford to own a house versus to afford to rent. Our UTH model is a rental model, but we see us filling in a space in this middle market, family renter housing that's really going to serve, we think, these middle income families, predominantly immigrant families, but including many middle income families that have long-term roots in California. And then this is the last one. I'm going to scroll down a little bit. Question number 3 is, aside from the coronavirus pandemic throwing the economy into turmoil, what other challenges will the California multifamily market face over the next 3 years? What factors will allow it to prosper? And I really think this is probably the most important question that's asked. I don't know that the answer is, as good as some of the early answers in the relative terms of, the power of the answer. But we're really looking again back to this vast undersupply story. So even if we say California continues to be an immigrant gateway, which we assess it will, and that maybe these families don't stick around so long, we're still so vastly undersupplied. And, we can debate what the amount of undersupply is, but I'll share statistics with you. Harvard's Joint Center for Housing Studies did a report in the last couple of years, and basically their assessment just in the low-income communities, low-income families, that there was a 1 million unit shortfall in the counties that make up Southern California. The reality is we don't produce enough housing statewide to catch up, and we don't, even across the entire state, we don't produce enough housing to even catch up for Southern California's shortfall, not even including the Bay Area and other, sort of MSAs, surrounding communities that are behind on their growth. So we're in such a deeply undersupplied story that the next 10 to 15 years to us are going to be exceptionally robust in the California marketplace based just on the undersupply story. That doesn't even include any of the other economic factors that go into housing. Now, that's not going to be true for all housing types, mind you. So if you've got your millennial and Gen Z studio and 1 bedroom right in the city center podium product, that's under pressure now. I think from a life cycle standpoint, that's not a good bet in the future. And in fact, I would offer for you guys, and I'll cover it in another video, to go through a study, a report that was done by ULI and RCLCO, a joint study, talking about the growth characteristics of family renter housing, right, as a specific product category in the rental markets, meaning those rental communities that are built to specifically serve families. And their assessment was just in the millennial demographic alone, there's something like 8 million households that were going to move into the family renter demographic in the next, several years. That was across the United States. So the reality, and again, we're talking about 8 million households, not 8 million people. So we're talking at least 16 million people, could be more if you're 3, right? We're looking at 24 million, but basically 8 million households moving into a demographic where they're going to need and really want family-centric housing. Again, UTH for our model is a family-centric renter housing model. So Kitty goes to ask this question. She says, fortunately, despite such restrictions, California remains a top market for investors due to its resilient and diverse employment base, high growth and high income job sectors, and the resulting top quality renter pool. Now, she's answering this in the context of luxury A product. This is her business, Of course, we understand she's looking at it from the standpoint of, the investment sale property types that she sells. And I know Katie, I've met her a couple times personally. Good person. So this is her, informed opinion. And I've in fact wanted you guys to see it because she's, been in the business, for a good period of time, is very, very intelligent about this business. We're just looking at this in the context of what's the future success of owning California rental housing, right? And this article, if anybody wants to go read it, I'll share the URL in the show notes. We do have issues like rent control. In fact, this answer before, if you go up above a little bit where I've highlighted here, she talks about rent control. Now, fortunately, like for us in the marketplace of new development, anything, right now that's 15 years or newer is not subject to rent control. Rent control is a conversation that's happening in many different cities, but we're seeing it particularly concentrated in the Western coastal markets. Look at, Seattle, Portland, Bay Area, Southern California, and in California we have something called the Costa-Hawkins law, which is referenced in this answer here, which basically right now stands, and there is a move to change that. But the reality is our expectation is that we don't see, and our fingers are crossed, of course, but informed opinions indicate to us that the state lawmakers have some realization that if they apply rent control to brand new housing, as soon as it's delivered, that's going to kill off the development marketplace. And we agree with that assessment. So we expect that 15-year window of exclusion from rent control to continue. Obviously, if you're an investor and you're looking at holding longer term than 15 years, then you have to factor that into your calculation and your pro formas. But we see it as a continuing safe harbor. What I would do is encourage you guys to go to our website, www.urbanpacific.com. Go to the investor education section. You're going to see tons of videos, articles, like I showed you a little bit, and I just gave you a little taste today. There's plenty more in there. We have a podcast section basically that has all the podcasts that I've been on, that Urban Pacific has been on over the years. Talks a lot about workforce housing. Of course, there's a lot of information about workforce housing on our site. Go check out our YouTube channel. It's under Urban Pacific Group of Companies. And I would just like to say thank you for joining me today, and look forward to presenting more assessments about the multifamily market and economic trends generally. Again, Scott Choppin checking out from Long Beach, California. Thanks so much.